Welcome to my channel. What I do in my videos is I run my discounted cash flow Excel model. I created it myself and I use it to figure out the value of a company's stock. I also look at the financial ratios of the company and compare them to its competitors. And I do this with you throughout the entire video, so it's like we're doing it together step by step. And the company I'm looking at in this video is Noble Midstream. And Noble Midstream is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. So let's get started with the model. This company has a market cap of $839.1 million. So it's a pretty small company. 839.1, and they're trading at $9.29, so that's one share of stock is $9.29. Now the way you value a company is you have to estimate the future free cash flows, and then you discount that number back to today's value, which is what I'm doing in this video. And the best way to figure out future free cash flows is to get their actual free cash flows. And that's what I'm doing exactly now, putting it into the model. And now I'm going to pull the net income. That's on the income statement. That's a profit and loss for the company. And I'll put that into the model. And we also need the revenue, which are the sales for each year. And it's really increasing a lot, the revenue. Wow. It went from 161 million to 700 million. That's pretty amazing. And you want to take a look at the numbers to make sure they look okay. I like to see free cash flow above net income, but it's below net income in most years, especially in 2017 and 18. And that could happen. Let me show you why. This is from their statement of cash flows on their 10K. And this first column is 2019, then the second is 2018, and the third is 2017. And the way you calculate free cash flow is cash flow from operations, which is $385 million in 2019, minus property, plant, and equipment. In 2018, they invested a lot of money in property, plant, and equipment, which is not a bad thing. That just means they're growing their company and they're investing in their business, and that will potentially lead to more growth in the future. So you want to just make sure when you see negative free cash flow, it's because they're investing in their company, and it's not because they're spending money on other things that may not benefit them. Also, you'll notice in 2019, they had positive $28 million of payables. That means they borrowed money, they bought something but didn't pay for it, so they book it as an accounts payable. When you buy something through accounts payable, through credit, you are actually increasing your cash flow. But in 2018, they paid $22 million in payables, and that decreases their cash flows. And when accounts receivables goes up, your cash flow goes down. Because accounts receivable is when people buy something from you on credit. So it's like you're giving them a product, but you're not getting anything for it. You're getting the future cash flow. Each year, they had an increase in accounts receivable, which decreased their cash flow. And if you look at the income statement, that's not actual cash you received. That's what was booked in the year. So a lot of people may have bought things on credit, so you didn't actually receive any cash for it. That's why we look at the cash flow statement. Let's look at the capital structure of the company so we know what discount rate to apply to the future cash flows. They pay $16 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to liability section. They have $1.5 billion of long-term debt. That's debt due after 12 months. Let's see how much taxes they pay. We'll go back to the income statement because interest payments are tax deductible. So let's use the 2016 number. The income before tax is $113 million and the income tax is $28 million. The effective tax rate is 25%, so the cost of debt is only 0.82%. That's pretty low. To get the cost of equity, we need the beta. The beta is how volatile the stock is relative to the market. And they have a beta of 3.92. So the stock is really volatile. It moves almost 4 times the market. Let's go back to the balance sheet, get their current assets, because we need to calculate the current ratio later. And current assets are mainly cash, accounts receivables, and inventory. That's $107 million. And current liabilities are debts and payables that are due within 12 months. That's $127 million. That's also part of the current ratio. They have no equity, so that means total assets equal total liabilities. Let's get their operating income on their income statement. That's $283 million. That's their earnings before interest and taxes. And let's look at the capital structure. They're 100% debt, and the cost of debt is 0.82%. So that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. It's all negative. But we also estimate a terminal value, which is all years past year 4. That's positive $4.1 billion. We discounted those numbers back to today's value using the weighted average cost of capital, and we get a value of the company of $1.6 billion. We divide that by 90 million shares. We get a calculated stock price of $18. It's trading at $9, so it's trading at a 49% discount. So it's a buy according to the model. Let's see what Simply Wall Street's at. They're higher. They're at $24. Let's see where the stock has been trading at. It looks like it was trading up in the 50s and 60s a few years back, but it's dropped quite a bit. So apparently investors are not willing to pay as much money for the company as they were in the past. They don't see the future of this company being that strong. Let's look at their financial ratios. They have a really good PE, a really good price to sales, and no price to book. So price to earnings ratio, the PE ratio is stock price over earnings per share. To get earnings per share, that's net income divided by shares outstanding. And below 15 is considered a good value. They're at 5.7, so that's really good. Price to sales ratio is stock price over sales per share. To get sales per share, that's revenue over shares outstanding. And they have 1.2. I like to see below 2.5, so that's a really good ratio. We can't look at the price to book because they have no equity. Current ratio 0.8, so that's current assets over current liabilities, so they cannot cover the current liabilities, so that's a concern. And their interest coverage ratio is 17.5, so they can easily cover their interest payments with their operating income. The best way to look at ratios is to compare them to similar companies. I've done videos on a Canadian company, Enbridge. I've done a video on Enterprise Products, Energy Transfer, Frontline Energy, Kinder Morgan, NBLX, ONEOK, Plains, and PBF Logistics. And here is Noble. And if Noble has a number in green, they're better than the average in the industry. If they're in red, they're worse than the average. So they are better than the average in price to earnings and price to sales. We can't get a price to book. They're a little below the average in current ratio. Most companies are below 1. We can't look at the ROE. ONEOK is best in that category. They're 100% debt like a lot of companies in this industry. And they have a really small market cap, under $1 billion. It is a really risky industry to invest in because oil prices are so low, the company's so leveraged, but greater risk, greater return. Thanks for watching the video.